Hello and welcome to Investment Insight, your clear take on the markets. Let's get started. We are diving deep today into a region that is, well, it's simultaneously the engine of global manufacturing and increasingly a flashpoint of extreme risk. I'm talking about East Asia.
That's right. And, historically, when we talk about investing there, the focus has always been on, supply chains, corporate growth, economic momentum,
Business fundamentals.
the business fundamentals. But the sources we reviewed for you today, they paint a dramatically different picture. That entire framework, it's fundamentally broken.
So what are we looking at now?
We're looking at extreme turbulence, and it's being created by two converging, absolutely massive structural forces that are just colliding with each other.
That's a really important point. Our goal in this deep dive isn't just to, summarize the latest headlines or currency moves.
Exactly. Our mission here is to really dissect the profound structural shifts that are happening, the kind of shifts that are forcing serious global investors, and that includes you, the U.S. investor, to completely rethink how you price risk and where you even look for returns anymore.
Okay, so let's lay out these two forces. We're focusing on a really dangerous duality today. First, the rapid, almost destabilizing escalation of tensions between China, Japan, and Taiwan.
Right, and this has moved the whole dynamic from, let's say, complex diplomacy to something much, much closer to an actual military face-off.
And the second force.
The second is the ongoing, aggressive, and frankly historic weakness of the Japanese yen, the JPY.
It's been in the headlines constant.
Constantly. The yen has completely abandoned its decades-long status as the ultimate safe haven asset. And that's creating this massive intervention stare-down with the Bank of Japan that is, in turn, reshaping global financing. Both of these shifts, they require our immediate, detailed understanding.
Let's begin with the geopolitical side then, because the sudden acceleration of risk there is truly alarming. I mean, just weeks ago, there was this feeling of cautious optimism in the air.
There was, and that's what makes the current situation so jarring. If you look back to late last month during the APEC meeting, the U.S. and Chinese leaders agreed to what many analysts were calling a temporary economic truce.
Right, an agreement to stabilize trade and sort of lower the temperature for a year or so.
Exactly. And that generated this, momentary sigh of relief across global markets. We saw these small relief rallies in regional stocks.
But according to the data we're looking at, that economic calm lasted, barely 10 days before the security situation just totally cratered?
Precisely. And this is the core insight for you as an investor. The data clearly shows a massive, definitive decoupling between economic policy and security policy.
Unpack that for us. What does decoupling mean in this context?
For decades, the assumption was that deep economic integration, the whole trade as a stabilizer thesis, would inherently reduce the chance of military conflict.
The idea that we won't fight our biggest customers.
Exactly. But the sources now argue that investors can no longer assume that. You can't assume that when trade relations stabilize, military risks just fade away. They are now operating under completely different, totally independent logics.
Wait, isn't that a terrifying premise? I mean, if military stability is the primary driver and it's overriding economic logic, how can any investor accurately model risk? Military action is inherently unpredictable.
That's why the geopolitical risk premium is spiking so high right now. You're absolutely right. The short-term relief rally we saw from that trade agreement was immediately wiped out by a security crisis. It just proved that security risk is now fundamentally in charge.
It's subordinate to everything else.
It is. Military events are non-linear, and that means investors have to price in a permanent structural uncertainty into these markets.
So a handshake in the economic sphere does not guarantee peace in the East China Sea. We have to separate those two calculations completely.
Completely. The sources are unanimous on this point. Military stability is now the #1 concern. It's fundamentally overriding all those previous worries about interest rates or marginal economic slowdowns.
Okay, so we know the truce was fragile. What was the specific action? What triggered this most recent rapid escalation into dangerous rhetoric and military posturing?
The primary trigger, the thing that lit the fuse, was an explicit and major policy shift from the Japanese government, and it instantly changed the strategic calculus for China.
What was the statement?
Prime Minister Takaichi made a striking, completely unambiguous statement declaring, and I'm quoting here, "A Taiwan contingency is a situation that threatens Japan's survival."
Wow. That is a staggering change in language, especially given Japan's historical post-war positioning. We need to spend a moment here explaining why that specific phrasing is such a geopolitical earthquake.
Yes, this is where the history really matters. That statement strongly suggests Japan's intention to exercise what's known as collective self-defense under its constitution.
Hey, what does that mean in plain English?
To get the gravity of this, you have to remember Japan's post-war peace constitution, which was basically imposed by the U.S. after World War II. Specifically, Article 9 legally restricts Japan to purely defensive military capabilities.
Right, they can't have an offensive military.
For over 70 years, Japan's military, the self-defense forces, has operated under this strict cap. They've historically held defense spending below 1% of GDP and avoided any action that could be seen as offensive outside its immediate territory.
So when Prime Minister Takaichi says a conflict that's, 60 miles across the sea threatens Japan's survival,
It provides the legal framework they need to shed those Article 9 constraints and potentially deploy their forces to aid Taiwan.
it's more than potential, though, isn't it? It sounds like a clear signal of intention.
Oh, it is. Takaichi's words are effectively signaling to the world, and especially to China, that Japan is prepared for possible military intervention across the Taiwan Strait. They are redefining their security perimeter to include Taiwan.
And for Beijing, which views Taiwan as an internal domestic issue.
This is the ultimate external interference.
So how did China react to this dramatic shift?
With extreme, hardline rhetoric and immediate diplomatic escalation, China immediately viewed this new posture not as self-defense, but as the return of Japanese militarism.
That's a deeply charged historical reference.
Incredibly charged, stemming from WWII atrocities. They accused Japan of internal interference in what they see as their most sovereign of issues.
Can you give us the specific details on the diplomatic warning? I mean, how severe were the threats leveled against Japan?
The sources confirmed the Chinese Foreign Ministry immediately summoned the Japanese ambassador. They declared that any intervention in the Taiwan issue would be considered an act of aggression.
An act of aggression. Those are not words you use lightly in diplomacy.
Not at all.
Okay.
And they issued a chilling official warning that Japan would face a strong counterattack. The language was clearly designed to intimidate and was unsparing in its severity.
And the diplomatic environment got even worse, didn't it? We saw a glimpse of the internal hardline atmosphere in China through a bizarre social media incident.
Yes, the level of fury was really evidenced by a deleted but widely reported social media comment from a specific Chinese diplomat. It wasn't an official statement, but it was highly revealing.
What did it say?
It told Japan to prepare to have your head cut off.
My goodness.
And while the comment was scrubbed, it was widely shared. It just demonstrated the deeply hardline, hawkish sentiment that's brewing internally. It contributed to this rapid and dangerous deterioration of national sentiment between the two rivals.
That is not the language of diplomacy.
No, that is the language of immediate confrontation. It's war footing.
And the terrifying part is that this rhetoric immediately translated into actual, dangerous military interaction. Tell us about the November 12th incident, which took this tension right to the brink of miscalculation.
Right, this incident is the concrete evidence that the risk has moved from the political sphere into the kinetic sphere. On November 12th, a Japanese maritime self-defense force destroyer approached China's flagship aircraft carrier, the Shandong.
And the Shandong was where?
The carrier was conducting a large training formation near Taiwan's eastern waters. So this approach by the Japanese destroyer was a clear, proactive signal of Japanese resolve right after that Takaichi statement.
And what was the reaction from the Chinese side?
The response was immediate and overtly aggressive. Chinese J-15 fighter jets launched from the carrier. They immediately scrambled and aggressively approached the Japanese ship.
How close did they get?
The source data confirms they came within dozens of meters. That's less than the length of a professional swimming pool.
Oh.
At that proximity, it's militarily classified as highly hazardous. It dramatically increases the risk of an accidental collision or a misfire that could just spiral into a full-on engagement.
That's a crucial detail. If we imagine two cars driving aggressively on the highway, side by side, bumping mirrors while going 80 miles an hour, this is the military equivalent.
It's a perfect analogy. A momentary failure in judgment or technology could cause a catastrophe for everyone. This is not just posturing. This is a failure of basic military safety protocols.
And of course, each side blamed the other.
Precisely. And predictably, both defense ministries immediately issued counterstatements, each blaming the other for dangerous, provocative behavior. The crucial takeaway here for you, the investor, is the change in the nature of the confrontation. This shift from verbal warnings to these kinetic near-miss incidents makes the probability of an accidental conflict, a catastrophic tail risk event, much, much higher.
Okay, let's pivot hard to the practical applications. For the U.S. investor looking at Asia, why should they care about a close call involving a Chinese carrier and a Japanese destroyer thousands of miles away? What does this actually mean for their portfolio?
This is so critical. The era where East Asian risk was purely about GDP growth and corporate debt is absolutely over. We have to now address the permanently applied geopolitical risk premium.
Let's start with that, the new constant risk.
The most immediate investment insight is that military conflict risk is now the primary risk factor for the entire Northeast Asian market. It's overriding everything else, concerns about economic slowdown, cyclical earnings, all of it.
So you're arguing this isn't just temporary volatility. You're saying this new state of affairs means these markets might never fully recover their previous valuations until the security situation fundamentally changes.
That is the structural insight the sources are pointing to. The risk of a Taiwan contingency is no longer a distant, abstract possibility. It is a constant risk that permanently depresses the valuation of regional indices.
And you can see this now.
The evidence is visible right now. Specifically, the Korean KOSPI and the Japanese Nikkei are being directly weighed down by this security threat.
This sounds like it's making the long-standing Asia discount even worse.
It is. The Korea-Japan discount has existed for years, primarily due to things like poor corporate governance, low dividend payouts, complex shareholding structures. But now, that discount is being severely exacerbated by this military risk premium.
Can you put that in perspective for our audience?
Historically, major indices like the Nikkei or KOSPI trade at a significant discount. We're talking 20% to 30% lower price-to-earnings ratios compared to their peers in the S&P 500, purely due to regional stability concerns. This military escalation guarantees that that differential is widening. It's creating a structural ceiling on valuations.
It's like if you buy a house in a known flood zone, you have to pay a mandatory higher insurance premium whether it floods this year or not.
Exactly. That's the perfect analogy. Investors must now apply a significantly higher mandatory geopolitical risk premium when investing in these markets. And that translates directly into lower stock valuations relative to similar companies in less risky regions, say Singapore or Australia. You are paying a premium to hold that stock, and that price is the risk.
But as we often see, high risk in one area creates massive opportunity in another. Takeichi's statement seems to be the starting gun for a multi-decade defense spending supercycle.
Absolutely. This is the positive structural trade in the region. Takeichi's explicit statement signals that Japan is shedding the constraints of its peace constitution and embarking on the largest rearmament effort since World War II. This creates a massive, multi-decade growth engine for the defense sector.
Can we quantify the magnitude of this shift? How big are we talking?
We can. Japan has historically struggled to even exceed 1% of GDP in defense spending. Now, the government is committed to doubling that to the NATO standard of 2% of GDP over the next 5 years.
Given Japan's massive economy, that's a huge number.
It translates into potentially hundreds of billions of dollars in new procurement, R&D, and defense infrastructure spending. It's a guaranteed long-term secular growth story.
So which companies or sectors are the direct, immediate beneficiaries of this supercycle?
Well, you're looking at structural growth for key Japanese heavy industry firms. Mitsubishi Heavy Industries, MHI for example, is central to naval construction. They build destroyers, submarines. They're also the primary contractor for assembling advanced fighter jet components, including the F-35.
And others.
Kawasaki Heavy Industries is deeply involved in submarine construction and specialized naval equipment. Their order books are guaranteed to swell for the next decade.
And the global implication is significant too. This benefits U.S. investors directly, right?
It is, because it strengthens the global security architecture. Increased Japanese military strength mandates deeper cooperation with the U.S. and South Korea, particularly in missile defense.
Which means more business for U.S. defense companies.
It directly benefits U.S. defense primes like Lockheed Martin and RTX. They supply the crucial technology, the radars, the missile systems that are necessary for integrating Japan into a broader regional defense shield. This supercycle is a tailwind for the entire allied defense complex.
Okay, let's talk about the tail risk. This is where the average investor, the person who owns an index fund or holds Apple stock, should really pay close attention. Why should they panic about a disagreement over who owns a patch of sea?
Because of the geography and the sheer density of global commerce that transits through that area. The Taiwan Strait is arguably the single most important shipping lane globally.
It's often called the world's windpipe.
That's the term, universally. It handles roughly 90% of the world's highest-end semiconductor supply. But just as crucial, it handles about 50% of the world's maritime traffic. We're talking massive flows of oil, LNG, raw materials, finished consumer goods.
That is an incredible, almost unbelievable concentration of global commerce passing right through a military flashpoint.
It is the ultimate bottleneck, and therefore any military tension, like that near-miss incident we talked about, it immediately injects chaos into the logistical chain.
And we aren't talking about small delays.
No. Tension instantly spikes marine insurance costs, the war risk premium for commercial vessels. It causes widespread logistical bottlenecks as shipping companies immediately start rerouting expensive cargo away from the strait, adding days, even weeks to transit times.
And what's the consequence if a conflict does break out, even accidentally?
This is the low-probability catastrophic impact event. A severe disruption, say a naval quarantine, mine laying, or even just a denial of insurance coverage, would instantly dry up the global supply of advanced semiconductors.
Hitting giants like TSMC, Samsung, SK Hynix.
Directly. And more broadly, cutting off 50% of maritime traffic would reignite global inflation, not just in tech goods, but broadly across energy and consumer staple sectors. It would be an economic disaster, which is why investors have to price in that risk premium right now.
So the core lesson from this first part is that the old framework where economic integration guarantees stability is dead. Security risk is now the non-negotiable cost of doing business in Northeast Asia.
Correct. The new Cold War structure is now the dominant paradigm. It's forcing capital to either accept a permanent discount or gravitate toward these defense beneficiaries.
Let's use that geopolitical instability as a bridge to our second major crisis, the Japanese yen. When global risk spikes, capital is supposed to rush into safe havens, and for 30 years, the yen was the gold standard of that safety. But today, the yen is failing what test?
That's the key paradigm shift. The yen is currently threatening to break 155 against the US dollar. That's a 35-year low. And crucially, it has completely lost its safe haven status. It's now seen by virtually every major market participant as the most attractive and cheapest funding currency globally.
We need to dedicate some time to explaining that term funding currency and the mechanics of what's called the carry trade for our listeners who are new to this.
Absolutely. Let's simplify the mechanism. Think of the yen as the cheapest gas station in the world right now. It's charging virtually nothing for credit.
Because Japanese interest rates are so low.
Incredibly low, controlled by the Bank of Japan. So global institutional investors, hedge funds, investment banks, they can borrow massive amounts of yen very, very cheaply, often at an interest cost of 0.5% or even less.
Okay, so they borrow all this ultra-cheap yen. Then what do they do with it?
They immediately convert that yen into US dollars, which drives the yen weaker. And then they use those dollars to fund investments in countries with high interest rates, like US Treasuries, which are currently yielding upwards of 5%. This is the carry trade.
Can we walk through that with a concrete number, just to make it clear?
Certainly. Let's imagine a fund wants to initiate a $100 million trade. They borrow, say, 14 billion yen at an annual interest rate of 0.5%. They immediately convert that into 100 million US dollars. Then they invest that 100 million in a US Treasury bill yielding 5.0%.
And the profit is the difference.
Their net profit, the carry, is the 4.5% rate differential. That's $4.5 million, risk-free, purely from the interest rate spread. This sustained high demand to sell yen to buy dollars guarantees structural weakness in the JPY. The yen is literally funding the rest of the world's high-yield strategies.
So investors are using cheap Japanese credit to chase higher returns abroad, and as long as that rate differential persists, the pressure on the yen remains immense.
And this weakness is persistent because it's being reinforced by three powerful structural factors.
Okay, what's the first one?
The primary institutional culprit is the Bank of Japan. They are perceived as being structurally, almost philosophically, behind the curve in policy normalization.
What does the data show?
The data shows they held their key rate steady at 0.5% during their October meeting. And this is despite domestic inflation running hot at 2.7%.
So inflation is high, but the BOJ is sticking to a rate that is nearly zero. Why are they so incredibly cautious compared to every other major central bank?
Their caution is really rooted in their history. Japan spent decades battling deep, painful deflation, a period where prices continually fell, which just crushed economic activity.
They're afraid of going back to that.
Terrified. Governor Ueda and the BOJ are terrified of reversing course too early and accidentally triggering a return to that deflationary trap. They want ironclad confirmation that wage growth is robust and sustainable before they commit to normalizing policy.
The sources noted some rare internal dissent, though, suggesting some policymakers are ready to move.
You did. While Governor Ueda remains cautious, two members of the policy board actually advocated for a 0.75% rate hike. That's a rare hawkish dissent that really underscores the internal tension. But ultimately, Ueda is the captain of the ship.
It's like driving a very large, slow ship.
A very large, slow ship that is reluctant to change course, even though the waves of inflation and currency weakness are just crashing over the bow. And that slowness reinforces the market's belief that the yen will remain the perpetual funding currency for the foreseeable future.
Okay, so that's factor one. The central bank is slow. What's the second factor compounding this?
It's the political reality. Is the government actually fighting the weakness, or are they tacitly accepting it?
And the answer is?
They are more than accepting it. They're giving it a political endorsement. Prime Minister Takaichi, inheriting the legacy of Abenomics, strongly supports a pro-growth, pro-easing stance. The political apparatus believes the long-term benefit of a weak yen outweighs the short-term cost of imported inflation.
What's the rationale there? I mean, why would a government tolerate rising costs for its own citizens?
It's simple. Export competitiveness. The Prime Minister's office has suggested that a weak yen is actually highly beneficial because it helps cushion the impact of global tariffs and keeps Japanese goods exceptionally competitive abroad.
So a weak yen makes a Toyota cheaper in New York.
It's exactly. Or a Sony television cheaper in Berlin compared to their competitors. This specific high-level signal tells the market that the Japanese government is currently allowing yen weakness to occur. That makes an expensive dollar-selling intervention less likely in the short term, which naturally encourages even more carry trades selling of the yen. The political math favors exporters and the stock market over the domestic consumer.
So we have a slow central bank and a supportive government. What's the third structural factor?
And finally, you have the context of U.S. monetary policy. This is the immovable object that's structurally reinforcing the JPY's decline.
The massive interest rate differential between the high-rate U.S. and the low-rate Japan is guaranteed to persist, sustaining the yen's role as a funding currency.
It is. And the final piece of evidence came on November 12th. The U.S. October CPI release came in hotter than expected. That specific U.S. inflation data point was crucial for the yen because it immediately cooled any hopes for an early Federal Reserve rate cut.
So if the Fed has to keep rates higher for longer,
the incentive to borrow cheap yen at 0.5% and invest in expensive dollars at 5.5% remains rock solid.
the trade stays on.
Precisely.
Right.
Until the U.S. begins aggressive rate cuts, which seems further and further away now, given the persistent strength in the U.S. labor market and sticky inflation, that structural difference guarantees the pressure on the yen will not ease. The market can comfortably calculate that the 5% rate differential is stable for the next 6 to 12 months, which just encourages high-volume carry trading.
Which brings us to this high-stakes, high-volume game of chicken the market is playing with the Japanese government. We know the 155 yen threshold was broken after that U.S. CPI shock. Why is that number 155 so important?
It's the political and economic pain threshold. After the U.S. CPI shock, the dollar-yen rate peaked at 155.80, breaking a 35-year record. Above 155 yen, the cost of imported raw materials and energy becomes crippling for Japan's domestic economy.
And which specific sectors feel the most pain at that level?
It hits the non-exporting sectors the hardest. Service industries, small to medium enterprises, and crucially, energy importers. Japan imports nearly all its oil, gas, and coal.
So when the yen weakens from, say, 140 to 155,
the cost of filling a tank of gas, heating a home, or running a factory rises dramatically. That drives up domestic inflation, which directly impacts the average voter. And that creates significant political instability for the ruling party.
So once that threshold was broken, the government had to react aggressively.
They immediately switched to maximum verbal intervention. On November 13th and 14th, you had Finance Minister Suzuki and Vice Minister Kanda issuing strong back-to-back warnings.
The kind of language were they using?
Highly charged phrases like high level of tension, extremely concerned, and will deal resolutely with one-sided movements. They're trying to create a fear factor. They're trying to signal to the market, we are watching you, do not push this further.
They're trying to scare the market into reversing the trend without having to spend billions of dollars of national reserves.
Exactly. The market, however, is notoriously difficult to scare.
So what's the consensus threshold for actual intervention? When do they pull the trigger?
The market is playing this so aggressively because they know verbal warnings are cheap. The consensus among serious traders is that 160 yen is widely seen as the absolute trigger for actual kinetic intervention.
What would that look like?
That means the Bank of Japan would enter the market, selling potentially tens of billions of dollars of reserves to buy yen, attempting to reverse the exchange rate by force and impose devastating losses on those speculative carry traders. It's a high-stakes standoff, and the closer we get to 160, the higher the volatility.
This brings us back to practical strategy. We've got two goals for our listeners: protection and profit. How can the individual U.S. investor navigate this volatile currency environment?
Okay, the most crucial shift is this. You must surgically remove the Japanese yen from your mental list of safety hedge instruments. Full stop.
Now, this contradicts decades of investment practice, where capital rushed into the yen during times of crisis. What's the concrete evidence that proves this shift has happened?
The evidence is the reaction to the military confrontation we just discussed. Remember that November 12th military escalation between the Chinese jets and the Japanese destroyer.
Yes, a classic risk-off event.
A classic acute risk-off event. But instead of strengthening, as it traditionally would have, the yen weakened against the dollar. This proves that the market now views the yen not as a reliable shelter, but as a source of risk, because it funds the carry trade. In times of geopolitical stress, carry traders close out their positions rapidly, which can lead to volatility, making the yen unreliable.
So if I need true portfolio insurance, where should I look for safety now that the yen has failed?
The data suggests moving towards more traditional, reliable hedges that hold up under both economic and geopolitical stress. If you need a currency that acts as a true safety valve, the data points clearly to physical gold, the US dollar itself, or the Swiss franc.
The Swiss franc is an interesting one.
The Swiss franc, for instance, benefits from Switzerland's political neutrality and its central bank's demonstrated willingness to stabilize its currency. That makes it a reliable countercyclical hedge.
Okay, let's talk about the carry trade itself. We mentioned it offers seemingly easy money, which attracts a lot of leverage.
And this easy money trade has a terrifying nickname, the Widowmaker.
Why is it called that?
It earned that name because the risk is a complete policy surprise. The major risk here is a sudden, unpredictable intervention. The BOJ dropping potentially $50 billion or more onto the market in a single afternoon.
Which could happen anytime between 155 and 160 yen.
Exactly. And that move could instantly cause the yen to spike 5 to 10 yen stronger in a matter of minutes, leading to massive instant losses for leveraged investors.
Is there a historical precedent for this kind of devastating move?
We do have them. You can think back to 1998 or more recently 2011. In 1998, specific hedge funds that were heavily shorting the yen were essentially wiped out in a sudden move. For leveraged traders, a 5 yen move can exceed their marginal collateral instantly.
It's like standing under a weak tree trying to collect easy apples.
That's a great analogy. You might get a lot of yield, but if the tree suddenly falls, if the BOJ intervenes, you're crushed. For individual investors, the crucial warning is to avoid high leverage in this trade. The risk of sudden policy-driven volatility is just immense.
So if we shouldn't trade the yen directly because of the Widowmaker risk, how can we safely profit from this persistent structural weakness?
The safest and most robust way is through yen weakness beneficiaries. Individual investors don't need to risk direct FX trading to capitalize on this trend. We can profit through the stock market where the gains are less leveraged but far more sustainable.
Explain the balance sheet mechanism behind these beneficiaries again. Use a concrete example for us.
It's a pure currency translation effect. These are Japanese global exporters who sell their products abroad and earn, say, 80% to 90% of their revenue in strong currencies like the US dollar or the euro. But crucially, they pay their costs, manufacturing, payroll, power in weak yen.
And how does that currency translation create profit?
Let's use Toyota as an example. Say Toyota sells a car in the US for 30,000 US dollars. If the yen is at 140, that sale converts to 4.2 million yen. But if the yen weakens to 150, that exact same $30,000 sale now converts to 4.5 million yen.
So that's an extra 300,000 yen in profit.
An extra 300,000 yen profit, around $2,000, generated purely from currency movement with no change in sales volume or price. When you multiply that by millions of units, their profits look enormous when they're brought back home.
And that means better earnings reports and rising stock prices purely because of the cheap yen.
Exactly. The key names here include giants like Toyota and Honda in the auto sector, Sony for electronics and content, Nintendo for gaming, Fanuc for high-end robotics, and major precision machinery manufacturers. These companies are structurally positioned to thrive in an environment where the yen is perpetually cheap.
And finally, this isn't just a Japan problem, is it? It has a regional ripple effect.
We must recognize that Japan's currency collapse is not an isolated event. This weakness ripples across the entire regional competitive landscape.
Specifically, the deepening yen weakness exerts downward pressure on the Korean won. Why do the currencies of these two competing nations move together?
Because they are fierce, head-to-head competitors in global export markets. Think electronics, autos, shipbuilding, industrial machinery. Yen weakness gives Japanese exporters an automatic, powerful price advantage over their Korean counterparts in third markets, like the US or Europe.
So if Korean companies don't lower their prices to compete with Japan's cheaper goods, they lose market share.
They do. And this competition pressure forces foreign capital to reevaluate Korean valuations. It often pushes foreign capital out of Korean markets and into those more profitable Japanese yen beneficiaries. For the Korean economy, this also drives up the cost of imports and capital goods, creating a challenging environment for Korean investors. This dynamic makes the yen's weakness a direct variable for all of East Asia.
This has been an absolutely critical deep dive. We've explored two massive converging forces that are completely redefining investment risk in Asia: the emergence of military tension as a market constant, and this fundamental paradigm shift in the yen's role from a safe harbor to a high-volume funding currency.
The crucial takeaway for you, the learner, is recognizing this structural paradigm shift. You must stop viewing the yen as a reliable form of portfolio insurance or safety. Instead, you should view the resultant yen weakness as an opportunity to potentially buy structurally sound Japanese export giants, the yen beneficiaries, who are receiving a guaranteed massive currency tailwind. You're effectively buying them at a significant discount.
It's a critical moment where security posturing and fundamental currency policy are colliding to create both exceptional risk and, at the same time, remarkable opportunity.
Absolutely. So, we'll leave you with this final provocative thought to consider. Given the structural shift towards a new Cold War security landscape and the reemergence of this catastrophic supply chain risk, should smart investors now begin prioritizing dedicated defense sector diversification, not just in the US but globally, over traditional high-beta tech growth in their standard portfolio allocations?
Something to mull over as you review your positions this week. Don't forget to subscribe and hit that like button.